So one of our most popular blogs for a few years now is Margin versus Markup. It's so popular that we created a downloadable guide, which I will include in the description for this video. But since I have joined the team full time and become a little more savvy about the industry and the way our audience works, I've kind of questioned the title Margin versus Markup. To me, it felt like there's a relationship between the two. So could you do me a favor and do a favor to our audience and kind of explain what that relationship is?
Well, first, I think I'll describe there is a relationship between the two, and that's the unfortunate part because they're so different, but yet everyone seems to want to use them synonymously between. You know, there's vast difference between margin and markup, and there's differences between margin and markup in an individual project or what your overall margin of your business is, and they are different. So for example, markup, when you're thinking about a project, if you have costs on a specific project and you're just going to mark them up 20%, 40%, whatever it is, and you take all your costs, your estimated costs, and you mark them up and you hope to make that profit. Well, the problem is in construction or even other manufacturing is there's two main things missing in that markup. One is your schedule. You have to give some lenience or leeway for your schedule changes. What does that mean? Well, what if it rains for 2 or 3 weeks on the project? You still carry your labor over. If you only bid 10 weeks of labor, but you have a 3-week delay and you keep your labor costs the same, well, now you're going to have 3 weeks worth of labor costs into that job that you've now marked up. But maybe your markup isn't enough to cover that kind of extra cost. It can work to your favor too. You might finish the job 3 weeks sooner, so you may have more profit, more markup. Here's what I'm trying to tell you. Margin is when you bake in all of your costs of your business, not only the cost of goods sold, materials, labor for that specific project or equipment cost, but you also have to layer in some costs of your overall business, things like insurance costs, rent, mortgages, payments of other debts, could be equipment financing that you have, could be car insurance, could be vehicles. Any of those costs, those are costs of your business. So for example, if all of those costs together add up to $100,000, you need to make sure you allocate that some portion of that $100,000 to each and every job that you're going to do, because that will eat up part of your margin on that job. So those are the major differences between markup versus margin. Markup is just an added, you're just adding some number or percent to the overall costs that you've estimated that job to be. The problem with doing that in a construction job, again, is you have a lot of variable costs, particularly in labor. It's hard to maintain a certain schedule, especially depending on what type of trade you are. Sometimes you're waiting on other trades in front of you. Sometimes you're waiting on other trades behind you. Sometimes you're waiting on owner, weather, etc. Margin, you want to make sure you allocate all of your costs, including your company's costs, into that bid so that you can be safe and you have enough money in that job, barring any unforeseen costs or expenses or time delays.
Can I ask a follow-up question?
Absolutely.
You talked about allocating a certain portion of your company's total overhead.
Mm-hmm.
Do you know how much to allocate?
So overhead is typically fixed expenses. What do I mean by fixed expenses? So again, those insurances, your rent, your monthly payments for debt service, phone, office, maybe certain salaries that you have in your office that are not allocated to a job. If you take the total of all of those costs, fixed costs that aren't related to a specific job, and add them up, and they add up to be $100,000 for the whole year, and you estimate you're going to invoice or produce $1 million a year in sales, well, then your overhead allocation to every project should be 10%, because you have $100,000 in cost not allocated to jobs, meaning it's not material, it's not the labor on that job, and certainly vehicles and cars and things like that, they're not reimbursable or billable in the specific schedule of values. So if you estimate you're going to do $1 million a year in sales and you have $100,000 of fixed cost, well then 10% of all of your revenue is going to go towards those expenses or your overhead expenses. So you need to allocate 10% of every single dollar you're going to invoice is going to go to pay your overhead. So if you take $1 million job, for example, and you have $500,000 of cost, and you think you have a 50% margin in that job, you're going to do $1 million, it costs you $500,000, and you forget the fact that you owe $100,000 in those expenses for the overhead, well, your real margin is now 40%, not 50%. Now, it'd be great to work off a 50% margin, so that's not practical. What most people try
That
to
sounds
work
awesome.
off of is a 20 or 25, maybe 30% margin. So if you
Right.
have that same $1 million job and $700,000 of cost, and you have a 10% retainage on that job, which means you're going to collect $900,000 this year, because retainage usually takes a year to collect, and you think you're going to have a $200,000 margin in there, but you forget to allocate that extra $100,000 in overhead costs, you really go from what you think is a 30% markup, deduct 10% for retainage, so now you only have a 20% markup, deduct another 10% in overhead costs, and you're operating with only a 10% margin, a real 10% cash flow margin, when you think you have a 30% margin. And it's that 10% cash flow margin that's the most important, because as we all know, in any business, cash flow is key. That is the thing that makes or breaks your business. If you don't have enough cash, or it's not enough cash coming in, a paper profit on an income statement means nothing if you don't have the cash to pay your payroll every week, or pay your material, or pay your suppliers. So it's really important to think about what your total sales are going to be for the year, estimated. And this is why a budget's so important. And you need to think about what your total costs are, which is a real fixed number. You can figure that out by adding up all your fixed expenses, and then take what percentage of those fixed expenses is going to be based off of what your estimated revenue is. And then you have to allocate that percent to every job. So if you're sitting out there and you're saying, okay, I'm going to bid $1 million for this job, and you got to allocate 100,000 to it, and you say, you know what, I'm never going to get the job if I bid $1 million for this. I'll be too high. Well, then the unfortunate truth is you either have too much in expenses and you need to trim some out, or your current financial load of your business doesn't have enough revenue attached to it to keep that financial load. So you either need to sell more, do more jobs at a profit, or you need to trim some of that staff or costs or expenses that you have in order for you to be able to properly grow your business and keep your business.
Thanks, Scott. That's an interesting point. And I think that it's really helpful for our audience to know how all these different pieces, the sales strategy, how that actually impacts all these other parts of your business, and the operations and the front office staff, and how it's all interconnected, and how you have to know all of these pieces if you're going to put together a comprehensive growth strategy that will work.
You do. You really do. And this is why we talk all the time, Autumn, about having the right financial partners, not lenders, but accountants, financial services. If you don't have proper documents to look at, your scorecard of your business, good income statement, a good balance sheet, to understand what those numbers mean to your business, it's so hard for you to predict and understand what you're going to make. Otherwise, you're just guessing. You're going out on a job, you're bidding it, and you're hoping and praying at the end of the year that you have some money left over. And when you don't, it's so hard to figure out because you don't have that monthly report card. This is why we tell all of our clients, and we really recommend it, and this was advice given to me when I first started business, Scott, think about where you want to be as a business and start acting like that from day one. And part of that means you have to have an accountant, you have to have financials, you have to keep good books so that you can make great decisions, especially as you're growing. The funny part is everyone thinks, oh, I'll do that when I'm a big, successful business. Problem is, big, successful businesses need their financials, and they need access to information just like everybody else. But small businesses, particularly ones that are growing or trying to grow, they need access to that information even more than a big business does, because they don't have that momentum yet carrying them over and over and over again. They need to make decisions on the fly. They need to know exactly what their costs are, what their expenses are, so they can make decisions on what jobs to bid, where to trim some cost, when should they borrow money under what structure, what are my real cash flows, how much money am I really making, but also how much money am I making that I actually am realizing on a monthly basis in cash flow. And those are the key things that you need to make decisions in order to be able to be a good businessman, woman, leader of your people. So it's really important to have a good accountant and work closely with them for these reasons.
All right. Well, all my questions are answered. So thank you so much for your time, and I will talk to you again soon.
Great. You're welcome. Have a great day.